Most people think the poor man's covered call is just about selling calls. It's not. The real edge is in stock selection. So let me walk you through exactly how I choose stocks for PMCCs using my recent meta trade as a real example. Step 1. I start with the bigger picture. Before I even touch options, I ask myself one simple question. Is this a stock I'd actually want long-term exposure to? Meta checked that box. Large cap, liquid, tons of options volume, and tight bid-ask spreads. PMCCs only work when liquidity is strong. Otherwise, you get chopped up on fills. Step 2. I wait for a pullback, not strength. Looking at the daily chart, Meta had a big pullback from the $780 area after earnings. That's important. Why? Because PMCCs work best when downside pressure is already priced in. My indicators showed price was in the reversal zone, bullish divergence on the oscillator, green reversal dot, and improving money flow. That tells me sellers are getting tired. I'm not predicting a moonshot. I just need stability or gradual upside. Step 3. I check valuation, and this is huge. Meta was trading at about a 7.2% discount to its implied fair value. That matters. I don't want to buy leaps on something that's wildly overvalued. Discounted or fair valued stocks give me margin for error. Step 4. I look at seasonality. This is where most traders stop doing homework. Historically, Meta's weakest months are September and October. Those were already behind us. November, December, and January, they've shown positive average returns over the last 10 years. That lines up perfectly with the PMCC. Slow grind higher while I collect premium. Step 5. Then I build the PMCC structure. Instead of tying up $62,000 buying shares, I bought a long-dated Leaps call expiring January 2028. The strike was deep in the money at $500. The cost was about $225 per contract, so around $22,000. This gives me stock-like exposure with way less capital. Then I sold the call against it. Expiring December 19, 2025, the strike was $675, and the credit received $10.15 per contract, so I collected $1,015. That's income upfront before the stock even moves. And here's what really happened. The Leaps gained over $3,700. The short call lost value, which is expected. The structure worked exactly as designed. Even when the short call moves against me, the Leaps gains more, and I walked away with an overall profit of around $3,200 in less than a month. The poor man's covered call success isn't about fancy adjustments. It's about strong stocks, pullbacks, not breakouts, reasonable valuation, favorable seasonality, and letting time do the heavy lifting. This is how smaller accounts trade like larger ones without tying up massive capital. If you want to see all the trades I'm making, the link's in my bio. Everything is broken down step by step.